Crude Oil Daily Analysis, June 29, 2011, commoditiesmansion.com. August crude oil is trading higher this morning as traders are anticipating a favorable outcome to the Greece austerity vote. A favorable vote is expected to drive the euro higher and the dollar lower. A cheaper dollar should translate into higher commodity prices, thus driving up demand for crude oil. Although traders anticipate a rally in the euro, no one is certain how high it will rally, given the good news, because much of the move may already be priced into the market. Following the initial thrust in the euro, the single currency is expected to run into retracement and resistance areas, which could reverse the intraday trend. A rally in the euro, whether it is short-lived or long-term, will mean that investors will put risk back on. This will be supportive for the crude oil market. Like the euro, crude oil may be susceptible to a quick reversal down should fundamental and technical conditions shift suddenly. In addition to the anticipated moves in the euro and the US dollar, traders will also be watching supply and demand figures from the US Energy Department. This weekly report is expected to show a decline in stocks, which should be supportive for the market. Today is also the start of the Strategic Petroleum Reserve Auction. The auction features the 60 million barrels of oil that the U.S. and its allies pledged to release into the open market over the next 30 days. Although last week the market reacted to the news by driving crude oil sharply lower, it looks like this week that cooler heads have prevailed and the market settled into a sideways to higher trade. Clearly the focus this week is on the austerity vote in Greece rather than the supply and demand fundamentals of the oil market. Once again, traders are reacting this morning as if the austerity measures will pass. This means that the risk trade is back on and that oil prices are trading firmer. The key will be what to do if the rally stalls and begins to correct. Technically, a new main bottom has been formed at 89.61. This doesn't mean a change in trend to up, however. This will only take place if the swing top at 95.70 is crossed. Besides the swing top at 95.70, you have a 50% price at 94.98, and you have a downtrending Gann angle coming in at 95.02. Since all of these prices are clustered tightly together, expectations are that a breakout above this area could trigger many stops, creating a potentially volatile situation. As you can see from this chart that we have a series of lower tops and lower bottoms, and that crossing this 95.70 will mean that the trend will turn up. In order to get there, it has to cross this downtrending Gann line from the 1552 top and also a 50% price zone at 94.98. So while we have a pretty good support base built between the Fibonacci level at 90.13 and the 50% level at 94.98, this market isn't going to turn bullish unless we start taking out this trend line and the old top. Also note that the market has taken back all of the loss it had last week, the day that the government announced the release of the Strategic Petroleum Reserve oil. This was expected, as we mentioned last week in our commentary, that a lot of times these so-called interventions get absorbed by the market fairly quickly. So if the goal is to lower energy prices to stimulate the economy, then the government's going to have to step up by approving production in either Alaska or the Gulf, or perhaps the exchange may have to raise margins to force speculators out of the market. For more analysis, go to commoditiesmansion.com.